The median paycheck in America is around $5,000 a month, and most people think replacing that in retirement takes $1 million sitting in a brokerage account. But what if the real number's a lot smaller? What if you could start this with $10,000 and about the cost of a coffee a day without ever selling a single stock? This video is about the lowest amount you actually need to live off Vanguard index funds. I'll show you exactly why the S&P 500, the most popular index fund in the world, can't deliver what most people think it can. I'll walk you through the dividend mistake that costs people years of income. I'll show you the Vanguard index funds I picked for the portfolio, and in the end, I'll show you the lowest amount you need to invest to hit $5,000 a month in dividend income, plus how to reach that same goal 10 years faster. Before we get into the numbers, here's the quick version of why index funds, even the boring ones, are the smartest tool for what we're building. When most people think about getting rich, they think rental properties, maybe the next big stock, maybe throwing some cash into crypto and praying for good results. And look, those can work, but they all come with stress, time, and risk. Risk that most people don't sign up for once they actually try it. Real estate sounds safe until you're getting a 2 a.m. call about a broken water heater. Stock picking sounds smart until one earnings report wipes out a year's worth of gains. And crypto, well, that's a roller coaster without a seatbelt. Index funds don't promise the highest return. They promise the most reliable one. You own hundreds of companies in one fund. The risk gets spread out. The swings get smoother. You buy, you hold, and time does all the work. For what we're doing here, building a paycheck that pays you forever without selling anything, they're the only tool that actually makes sense. But before you start picking funds, there's one mistake most people make the second they hear the word dividends. See, when people hear dividend investing, the first thing they go looking for is the biggest yield they can find. 7%, 9%, sometimes 12%. And on paper, that sounds incredible. Bigger yield, bigger paycheck, right? Here's the trap. A huge yield is almost always the market's way of telling you something's off, something's wrong here. The share price is falling, the dividend is about to get cut, the company's in trouble. You think you're getting paid more, but what you're actually doing is buying a sinking ship that hands you a check on its way down. So this portfolio doesn't chase yield, it builds total return. 3 things stacked together: a reliable dividend yield today, dividend growth every year, and share price appreciation in the background. Here's why that matters. A fund paying 2.5% today, growing its dividend 10% a year, will definitely outpay a fund stuck at 7% inside of a decade. The high-yield fund stands still while the growing one compounds. That's the gap. But before John can build this, there's a filter every fund has to pass. John needs 5 funds, and every one of them has to do a different job. The first thing he's looking for is a reliable dividend yield, something that actually pays today, not so low that it's pointless, yet not so high that it screams this is going to get cut next quarter. That's the foundation, the starting income. The second thing is dividend growth, the 10-year track record of how fast the fund's dividend has been climbing. This is the piece almost everyone ignores. A fund growing its dividend at 10% a year is doubling your income every 7 years. That's where the real income story comes from. Pay attention to dividend growth. The third thing is share price appreciation. John doesn't just want a paycheck, he wants the account to be worth something too. Appreciation builds the principal amount in the background even when he's not selling anything. So now the question is, why go this route? Why not just buy the most famous index fund in the world and call it a day? Well, you could, and honestly, for most goals, that's the right answer. But here's the problem. The S&P 500 wasn't built to pay you. It was built to grow. Here's what that actually costs. If you wanted to live off VOO dividends starting today, no waiting, no growth, just buy and collect, you would need $5.7 million in your account right now to receive $5,000 a month. $5.7 million for the median paycheck. The average American has about $192,000 saved by retirement, so the just buy VOO answer asks John for almost 30 times what most people retire with. Okay, so he doesn't have the $5.7 million required. Very few people do. So what if John gives the money time to grow, buys VOO once, lets it compound for 30 years, then lives off the dividends? Well, he'd still need to invest $1.25 million today. You see, VOO is great at building wealth, but it's terrible at paying you, and that's why John needs something built differently. Next, I'll show you the list of Vanguard index funds John picked for his portfolio, and in the end, I'll show you the lowest amount you need for this portfolio to pay $5,000 a month in dividend income, plus how to reach that same goal 10 years faster. But first, let's take a look at the funds. John starts with the growth engine, the Vanguard Dividend Appreciation Index Fund, ticker VDADX. This isn't the highest yielding fund in the portfolio. It pays 1.49%, which sounds small, but here's what it does that nothing else does. It only holds companies that have raised their dividend every year for at least a decade. Coca-Cola, Microsoft, Procter & Gamble, the companies that don't just pay you, they pay you more every single year. VDADX has grown its dividend at 8.46% a year for the last decade, and the share price has been climbing at almost 11% a year on top of that. It's the slowest income, but has solid growing income. That's the foundation. The second fund is the one most dividend investors skip, the Vanguard Energy Index Fund, or VENAX. Energy is the sector nobody talks about anymore. Everyone's chasing tech, chasing AI, chasing growth. But while everyone's looking the other way, the energy majors are paying some of the most consistent dividends in the market. VENAX pays 2.48% today. Its dividend has grown 9.6% a year over the past 10 years. The trade-off, share price growth, is slower at 5.66%. That's the deal with energy. You get paid well to wait. The third fund is the Vanguard Total International Stock Index Fund, or VTIAX. This is the wide net, over 8,000 companies from every developed and emerging market outside the US, Japan, Germany, Brazil, India, the companies most American investors never look at, but should. The yield is 2.66%. Dividend growth has been running 12.23% a year, significantly faster than anything domestic. Share price appreciation is more modest at 6.59%, but the income story is the reason this fund is here. International stocks have been out of favor for over a decade. That's exactly why they're sitting on higher yields and faster growing dividends. You're getting paid to be patient with the part of the world Wall Street is ignoring. Fund 4 is the Vanguard International High Dividend Yield Index Fund, or VIHAX. Now, before anyone says this overlaps with the fund I just covered, here's what makes it different. VTIAX is built to track every stock outside the US, winners, losers, payers, non-payers. It doesn't care about dividends. VIHAX does. It throws out the bottom half of payers and the companies expected to stop paying altogether. Roughly 7,000 stocks that live inside VTIAX never make it into VIHAX. That's why VIHAX pays 3.24%, the highest yield in the entire portfolio. Its dividend has grown 11.65% a year. Share price moves slower at 6.35%. The last fund is the Vanguard International Dividend Appreciation Index Fund, or VIAAX. And here's where people get tripped up. They look at this fund and assume it's the same as VIHAX, but it's the opposite. VIHAX wants the biggest payers today. VIAAX explicitly excludes them. It only holds international companies with at least 7 straight years of dividend growth, the slow, steady payers that get bigger every year. The two funds actually filter each other out. VIAAX pays 2.09% today, but its dividend has grown 13.32% a year, the fastest in the entire portfolio. Share price appreciation is the trade-off at 5.61%. This is the long game. Small income now, big income later. So now John has all 5 Vanguard index funds. The next step is figuring out what this portfolio actually pays. And the math here is simpler than most people expect. John's giving each of the 5 funds an equal weight, 20% of the money in each one. So to find the blended dividend yield, he just averages the 5 yields together. VDADX pays 1.49%. VENAX pays 2.48%, VTIAX pays 2.66%, VIHAX pays 3.42%, and VIAAX pays 2.09%. Add those 5 numbers up, divide by 5, and the portfolio's blended dividend yield comes out to 2.43%. You do the same for dividend growth and share price appreciation. Add the 5 numbers, divide by 5. So the portfolio's dividend is growing at 11.05% a year, and the portfolio itself is appreciating at around 6.99% annually. So let's see what it actually takes to live off this thing. Here's John's setup. He starts with $10,000 and he commits to roughly the cost of a coffee a day, $7, going into the portfolio every day. Quick note before the numbers, this assumes John's running it through a Roth IRA, so the dividends compound tax-free. So what does 30 years of that look like? After year 1, John's account would sit at $13,497. Slow start. Compounding hasn't really kicked in yet. By year 10, he'd be at $66,641. By year 20, the portfolio would be worth $239,134, and that's the moment the curve steepens, when reinvested dividends start outpacing his daily contributions. And by year 30, $895,338, paying him $5,000 every single month. Here's the breakdown of where that money would come from. John would put in about $86,650 of his own money over 30 years. The market would add $431,248 in capital appreciation, and reinvested dividends would pile on another $377,440. That's the smallest amount this works on. But maybe 30 years isn't your timeline. Maybe you want this in 20. Well, here's what that costs. John starts with $70,000 instead of $10,000 and now commits $35 a day instead of $7. After year 1, John's account would already sit at $89,366. The bigger starting amount means compounding hits the ground running. By year 10, the portfolio would be worth $384,662, almost 6 times the 30-year version at the same point. That's what the extra cash on the front end buys. And by year 20, the portfolio would land at $1,346,338, paying him $61,535 a year in dividends. That's $5,128 a month. Same targets, hit a decade earlier. But here's the honest math and the humbling truth. The 30-year version would cost John $86,650 in total contributions. The 20-year version costs $325,500, almost 4 times more cash out of pocket just to compress the timeline by a decade.